Well, hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. We made it to week 6, chapter 6. And I want to say thank you so much for your hard work so far in the class. It has been a very enjoyable class so far. All of you have been working hard to make sure that your work is in on time and you're using the extra class time on Thursdays to get your work done. And I really appreciate that. I appreciate the fact that you're all here most of the time and that you're working hard to stay on top of this stuff. I know it gets overwhelming sometimes, and my job is to make this stuff digestible, understandable, and all around a little bit more easygoing. So I know accounting can be a little daunting. We're talking about numbers, talking about formulas, talking about all that kind of stuff. And I just try to make it understandable for you. Yeah. So thank you. Thank you so much for your hard work so far. I really appreciate it. Today, I want to talk about this concept called inventory. Last week, I had you thinking about your favorite retailer. Remember? I said my favorite retailer was Macy's. And a few of you threw out some other retailers. Remind me, what are your favorite retailers? Tell me.
Like Macy's and Nordstrom.
Nordstrom, Macy's,
Amazon.
I was
Amazon.
about to say, yeah, Amazon for the convenience.
Yeah, I like that one. Yep, Amazon, Nordstrom,
Can never go wrong with Walmart or Target.
Walmart, Target. Yep, absolutely. I'm a Target fashionista myself. Wonderful. Okay, very cool. Thank you. So we got all the big players, right? And of course, we got a couple of local shops that we all enjoy as well. I wanted you to stay with this theme that we started with last week and thinking about your favorite retailer. And today, we're going to talk more about inventory, which are the products that those companies that you like to buy from, what they sell. Inventory is what they sell. Okay, that's their inventory. And retailers, like the ones that you mentioned, they all buy their inventory from distributors or manufacturers. And it costs them something to buy that, right? They're not getting the stuff for free. Macy's, Nordstrom, they buy stuff from their distributors and then they sell it to us, their customers. And whatever it costs them to buy that inventory from the distributors and the cost of getting it to the store and the cost of selling it to us, call that cost of sales, cost of goods sold, which we learned a little bit about last week. So today, I want to reinforce those concepts of inventory and cost of goods sold. We learned a little bit about it last week when we talked about our favorite retailers, and we're going to carry on with that theme today. So again, think about your favorite retailer, your Macy's, your Amazon, your Target, your Walmart, etc. Think about the stuff that they sell, their inventory. Inventory belongs to them. Yep, that's the goods inside the store. That is the store's inventory. They sell those products to you, the customer. When they sell it to you, it costs them something. It's the purchase price of the inventory, plus maybe some expenses, like carrying cost. That's the cost of holding it on the shelves, or transportation costs, and maybe some insurance, and maybe some sales commissions, etc. Those are all considered what we say cost of sales. So we're going to talk more about this inventory concept. We're going to talk about the cost of sales, cost of goods sold. We're also going to talk about how we manage the inventory and how we value the inventory through a couple of different methods. We're going to talk about things like specific identification, the first in, first out method, the last in, first out method, and the weighted average method to value our inventory. I'm going to focus a lot on those key concepts because it's important that we, as business managers or business owners, need to understand how to value our inventory, especially for tax reasons, right? So that's the key concepts we're going to talk about tonight. So first, let's talk about the inventory itself. What makes up inventory, or the cost of inventory? Inventory are the goods that the company owns and sells. Again, think about your favorite retailer, Macy's, or Walmart, Target, whatever. Those companies purchase their inventory from distributors. Once they've purchased the inventory and it's delivered to the store, it's owned by the store, by the company. They sell that inventory to the customers. Okay? That is the definition of inventory, are those products, yeah? It's important to understand that it's not just the purchase price. It's also who's responsible for the inventory while it's in transit. Who's responsible for the inventory if it's on consignment? What happens to the inventory when it's damaged or obsolete? Let's break these three things down. When your inventory is in transit, it depends on who's responsible, who owns the inventory while it's in transit. We talked briefly about this last week. One term we had mentioned was free on board. Free on board, FOB, free on board. And the other one was free on board destination. Free on board shipping point and free on board destination. Either of those terms tells us who's responsible, who owns the inventory while it is in transit. If it's free on board destination, that means that the buyer is responsible for it while it's in transit. And the opposite is for free on board shipping point. The seller will be responsible while it's in transit. That's one key thing to pay attention to. Another is called consignment. Now, you may have heard this term consignment before, but maybe never quite understood what it meant. Have you ever been to a consignment shop? Has anyone in the class ever been to a consignment shop before?
Yes.
What do you think a consignment shop is, Renaud?
A thrift shop
A
or
thrift
like
shop.
a flea market.
Yeah, exactly. So when you go to the thrift shop or to the market, who do you think owns the stuff you're buying? The store? Or is it the individuals who gave it to the store? What do you think?
Store.
It's
So
the individuals.
it's the individuals.
That's the difference between the thrift store and the consignment shop. The consignment shop is technically like something you give to an art gallery until it sells out. A thrift store is owned by the store, but the consignment is owned by, that's what consign means, to co-sign it over to someone else.
Very well done, Maxine. Yes, absolutely correct. So, to clarify, a Goodwill or a Salvation Army or whatever your favorite thrift shop is, products in those stores, they belong to the store. Okay, they were typically donated or somehow otherwise got to those shops, right? Those are owned by the store. A consignment shop is a store, an art gallery, in Maxine's example, where individual people bring their stuff to be sold on their behalf. Okay, and then when the stuff is sold on their behalf, the shop owner, consignment shop owner, gives most of the proceeds to the person the shop sold it for. Okay, so here's an example. Dr. B has some extra stuff laying around his house. Wants to sell the stuff, but doesn't want to go through the pain of listing it online, having strangers come down, etc. So instead, Dr. B goes down to the consignment shop with the stuff, brings it into the store, talks to the shop owner, and the shop owner says, I'll sell your stuff for you and charge you a small commission. Cool. I, Dr. B, am still responsible for my stuff that the consignment shop owner has in their possession until the consignment shop owner sells my stuff. At which point the consignment shop gives me the proceeds and keeps a small amount for themselves, a commission, if you will, to pay for the overhead of the store, etc. Is that clear? Does everyone kind of now have a good understanding of what a consignment shop is?
Yeah, that's clear. I didn't
Yes,
know.
thank you.
I didn't know thrift stores did that. You could bring stuff there and they'll sell it for you, and they get a percentage of it.
Yeah, there's not a whole lot of them around, Damon, but they're out there. I don't know if a lot of them times are owned locally. You know, very small stores. I'm sure there's a bunch scattered throughout DC. Oftentimes it'll say consignment shop somewhere on the window, and if you see something like that, that's a consignment shop, and that's exactly the way it works. They'll sell your stuff for you, and then they'll give you most of the proceeds and keep some for themselves, right? It's a lot of people like that because it takes a lot of the challenges, right, out of having to sell it on their own. Yeah, just keep that in mind because the consignment shops are very unique and they have unique situations, unique concepts. Oftentimes, if you ever go into a consignment shop, you'll notice that the tag, the sale tag, that it says the price on it, it'll also have like a small couple of numbers, or it might even have someone's name. And what that does is it indicates to the consignment shop owner who owns the property and who to give the proceeds to. So that's why when you go to a consignment shop, you might see a tag on the product, and they'll have like a small code or something like that, or even someone's name. That indicates who owns the inventory. I learned that one by visiting a consignment shop.
That's how too. I thought it was a store, and I went in there, and and also with consignment, you can negotiate a little bit.
Yeah, exactly. Yep, and that's kind of some of the fun part, I think, Maxine, is being able to negotiate.
A little bit, because sometimes.
Exactly. Very cool. And the third thing I want you to take into consideration when we're talking are damaged or obsolete inventory. Sometimes in the store might receive goods from the distributor. They're damaged. I've seen this happen myself a long time ago when I was working at Sears as a department manager. One thing I saw was we received some inventory. I think it was a clothing. Yeah, it was a shipment of clothing, a new apparel line or whatever. And I opened up the box, and there was like a ink or some type of like dye that was all over it, all over the clothing. So it arrived damaged. And so I reported it to the manager, and the manager calls the distributor up and says, "Hey, I got a shipment of damaged product. I need to either have it exchanged or refunded." So damaged goods, that happens from time to time. And the last part of it here is obsolete inventory. Obsolete inventory, the word obsolete means it's out of date. It's no longer relevant. It's no longer useful. Obsolete. It's kind of like, I don't even know what number they're on these days. The iPhone, whatever number. What's the highest number? Does anyone know? Is it like 20 something? I don't even know. Say it's 23, okay?
It's the 14.
14, thank you. So we got the iPhone 14. This is the latest and greatest, right? And what does that mean? It means that the iPhone 13 is now obsolete. It's been replaced with a newer model. Okay? That's what the word obsolete means. No longer relevant. It's been replaced with a more updated version. Obsolete. Okay. So now that we got the special items out of the way, let's focus again on who's responsible while the goods are in transit. Free on board shipping point. This means that the buyer is responsible when it's being shipped. And free on board destination. This is where the buyer is responsible after the inventory arrives at the destination, which means that the seller is responsible for product while it's being shipped. So recap, free on board shipping point, the buyer's responsible while the inventory is in transit. Free on board destination, the seller's responsible while it's in transit. Consignment, we talked about the consignment store, and here are the terms that relate to the consignment store. Consignor, consigner. Sorry. The consigner, that's the person who owns the goods. So in the earlier example, when I was trying to sell my product, my goods, I brought it to the consignment shop. In that example, I'm the consigner. I still own the goods. The consignee, that's the consignment shop. The consignee, they sell the goods on behalf of the owner. store is selling my goods on behalf of me. Merchandise is commonly included in the inventory of the consignor. It's my merchandise, my inventory. I own it. I'm just letting the consignee sell it for me. So, the consignment shop, consignee, will never have inventory. Shop doesn't own any of the stuff in there. It's just a holding place before it gets sold on behalf of the owners. So therefore, if you ever do accounting for a consignment shop, notice that the consignment shop does not have any inventory. When goods are damaged or obsolete, or product is damaged or obsolete, you can't sell it. Or we shouldn't sell it anyway. Damaged or obsolete goods are not reported in inventory if they cannot be sold. If something's damaged, you might be able to sell it. Or I might not be able to sell it depending on the damage, right? Years ago, when you were able to buy appliances at the store, there used to be an area called Scratch and Dent. The Scratch and Dent area is an area inside the store where you can buy scratched or dented what am I trying to say? Scratched or dented products like a dishwasher or a refrigerator, washer or dryer at a discounted price. It's discounted because it had a scratch or a dent in it. It's damaged. But it still works, so I can still sell it. If the inventory is damaged to the point where it does not work, I should not sell it, and therefore I will not report it in my inventory. See? If a product is obsolete, like the iPhone 13, because the iPhone 14 came out, I can still sell the iPhone 13. I'll sell it at a reduced price. It still works. It's just older. No big deal, right? But if the iPhone 20 comes out and I still have iPhone 13s in inventory, I probably can't sell it at that point. I'm just going to want to buy it. I send it back. Damaged or obsolete goods can be sold or included in the inventory at net realizable value. In other words, I record the inventory price at what it's worth in the market. Net realizable value. Net realizable value is the sales price minus any sales cost. Net realizable value. Sometimes I might sell the damaged or obsolete inventory below its net realizable value. In that case, I record it as a loss. Now for the fun part. The cost of inventory. One of the fun parts. As I had mentioned earlier, it's not just the purchase price. It's also cost of shipping, storing, and insuring the inventory. So when Macy's buys their clothing from their distributor, in that cost is not just the purchase price of the clothing. It also includes the cost of shipping, storing, and insuring the clothing. All of those costs included in the cost of the inventory. Inventory cost represents the invoice cost, total cost, minus any discounts. We learned about discounts last week, remember? If I pay early, 2% discount. If I pay within 10 days, otherwise the whole thing's due in 30 days, remember? That's a discount. And plus the other cost. That's the total cost of inventory. It's the purchase price plus shipping, storage, and insurance minus any discounts. It's really important that stores take physical inventory, even if they are on a perpetual inventory system. Remember, we talked about this last week. Perpetual inventory means that we continuously update our inventory records as we make the sales. And typically it's done using the barcode, right? Perpetual inventory. We update it as we make the sales and the purchases. Even if the company uses perpetual inventory system, we should always do a physical count of inventory at least once per year. The reason for this is we want to match what our accounting system says we have on hand with what we actually have on hand. There might be a difference. That difference was probably caused by shrinkage in the inventory. Remember, shrinkage in inventory comes from either somebody stole it, or we lost it, or we used it, or it got damaged. Physical count once a year, match it with what's actually in your inventory system. If they don't match, we have to make an adjusting entry. Most companies have what we call inventory tickets. It helps us to track what's on each shelf. If you've ever gone into Target or Walmart or Macy's or some other store and noticed there's little stickers on all the shelves, and it might say an inventory company's name on it. Okay, they're doing a physical count. It helps to control what they've already counted, because you know at a Walmart there's 100,000 items, 100,000 different items in that store. You know how long it takes to count all that? Long time. Okay, so in order to keep track of what was already counted, that's where those little stickers come into play. Counters don't have any inventory responsibility. The store does. Counters confirm the existence, amount, and the condition of all the inventory. So when you see people doing a physical inventory count, confirming the inventory is actually there, how many are there, how much is it being sold for. Lastly, they might do a second count to confirm that the first count was correct. So now for the very important conversation. If any of you have questions on these four things as we talk about them, please interrupt me and let me know, okay? It's important that we all understand these four concepts of valuing our inventory. These four concepts of valuing inventory, they help us to understand the true cost of our inventory. There's four ways to do it. The first is called specific identification. Very few companies use specific identification. Most commonly, a car dealership would use specific identification. Or, I like this one, an Etsy shop owner, Etsy.com, ETSY, right? Etsy. ETSY, Etsy. Shop owner use specific identification. Because they don't sell a lot of different products. They're small, unique products. Specific identification. Think a car dealership. They use the vehicle identification number as their specific identification. That one's very unique. Very few companies use this. The second one is used by almost 50% of all companies. First in, first out. I'm going to break this one down easily for you. Think about the grocery store. You might go to Giant, Safeway, Wegmans, or whatever your favorite grocery store is. 7-Eleven, I don't know, whatever you like. First in, first out. The grocery store receives a delivery of milk and bread from their distributors. The first one that they receive in should be the first one that they sell. Why? Who can tell me why?
Because they are perishable goods.
It's what? I'm sorry, Elijah?
Perishable goods, because they are perishable. They
Yeah,
easily
perishable. Exactly. Yeah, they're going to expire. Right? Exactly. Thank you, Elijah. Yeah. The milk is going to go bad. Bread's going to get stale. The chips are going to go bad. Right? They have expiration dates, especially at a grocery store. Yeah. So, the reason why most companies use first in, first out method is because they sell perishable goods. First in, first out. It means the first stuff that the store receives is what they're going to sell first. First in, first out. So when you hear first in, first out, think of my grocery store example. We'll talk more about this using some math and technical examples as well. Third method is called last in, first out. Only about 28%, 30% of companies use this method. Still a good amount of companies. Last in, first out means I make multiple purchases from my vendors, add it on my shelves, right? The last amount that I purchased is going to be the first ones that I'll sell. Okay, last in, first out. Companies that use last in, first out, these are typically your retailers that sell non-perishable goods. Example would be Best Buy. Another example would be Amazon. Big companies, but they sell mostly non-perishable goods. So they use the last in, first out method. Lastly, we have the weighted average method. About 20% of companies use this inventory costing method. That's how it works. The company makes multiple purchases from their vendors throughout the year. The purchases come from the vendors, they arrive at the store, and then they sell the inventory, right? We take all of those purchases that the store made, we average it out. We take the cost of each purchase, add them up, and divide it by the number of purchases. Get the weighted average. About 20% of companies use that method. So I'm going to break down each one a little bit further for you in a very simple slide. Again, the specific identification method, very few companies use that, and it's really for companies that sell one-off products or car dealership, something like that. We're not terribly concerned about that. What I want you to be concerned with is first in, first out, last in, first out, and weighted average. And I apologize, this slide looks a little blurry to me. It could be my eyes, I'm not sure. But I'll break it down for you as best I can. The first in, first out method. Think about your grocery store, okay? In this example, we have 3 different purchases that the company made. On May 1st, we purchased $45 worth of goods from our vendors. On May 3rd, we purchased $65 worth of goods from our vendors. On May 6th, we purchased $70 worth of goods from our vendors. So in this example, I have 3 purchases. May 1st, May 3rd, and May 6th for $45, $65, and $70 respectively. Using the first in, first out method, for my cost of goods sold, it would be $45. Why? Because first in, first out. On May 1st, first of the month, I purchased $45 worth of stuff. I'm going to sell that first. First in, first out. Means I sell it first, yeah? What came in first is what I sell first. So my cost of goods sold is going to be $45. I sold $100 worth of goods so far for the month of May. Cost of goods sold in this example for first in, first out is $45. It was the first one that I purchased. This is the first one I sold. That gives me a gross profit of $55. Pardon me. Reminder, gross profit, we take sales minus cost of goods sold. That's how you find gross profit. Now what goes on our balance sheet for our remaining inventory? Remember, the balance sheet has assets, liabilities, and equity. Inventory is an asset. It's a current asset. What's remaining? That's what goes on my balance sheet. $65 and $70 purchases is what's left. So I sold May 1. So I add 65 plus 70 to get $135 inventory balance. That's what's left, right? So that's first in, first out. Any questions on first in, first out, or does it make a whole lot of sense?
It makes sense.
Cool. Great, thanks. Okay, on to the second one. Last in, first out. Just as it sounds, I sold my last purchase first. So here are my purchases again. $45 May 1, $65 May 3, and $70 May 6. The cost of goods sold is going to be $70. It was my last purchase, the last one to come in. And it's the first one to go out. First one to sell, right? That's my Best Buy example, right? So my sales, $100. My cost of goods sold in first and first out is 70. It's the last one in. It's the first one to be sold. That leaves me with a gross profit of $30. Net sales minus cost of goods sold equals gross profit. What's left? That's my inventory balance. It would be 65 plus 45. Gives me $110 inventory balance for last in, first out. On to weighted average. Weighted average, the way it works is we take all of our purchases, we add up all of our purchases, and we divide by the number of purchases. So it's total purchase amount divided by the number of purchases. So I take May 1, 45 plus May 3, 65 plus 670. That gives me $180 worth of purchases. I'm going to divide that by 3 purchases. That gives me an average of $60 per purchase. Yeah, we did that. So, I sold $60 worth. Sales, 100 minus cost of goods sold, 60 equals gross profit of 40. My remaining inventory is 120. How do we get that? I sold a batch of inventory, so it has to be 2 left. $60 each average times 2 remaining gives me an inventory balance of 120. Doing okay? All right.
Excuse me, would you be able to repeat the first one, the first in and first out, how the inventory got to 135?
Sure, of course. No problem. So, with first in, first out method, it means that my first purchase is the first one that I'm going to sell. Think of how a grocery store works. Perishable products. So I need to sell that first. So I made a purchase on May 1, $45, May 3, $65, and May 6, $70. So I'm going to sell May 1 first. Sell May 1 first. So cost of goods sold is 45. I sold the $45 amount first. That means I have remaining inventory balance of 135. I take May 3rd and May 6th purchases, add them together, to get 135. That help, Tina?
Yes.
Awesome. Good question. In inventory, or any time that we talk about inventory, I always want you to think about the physical flow of that inventory. Think about how it works at a grocery store. You know how all the newest stuff is always in the back, right? There's a trick if you didn't know this. Anytime you go to get milk or bread or anything that expires at a grocery store, reach in the back. That's where the newest stuff is. Okay. Think of the physical flow. When we think about the physical flow of the inventory, it helps us to track the cost. So this flow chart here shows us how inventory works. Take our beginning balance inventory, how much we started the month with, plus any purchases we've made throughout the month, equal our merchandise available for sale. Can also be found by taking your ending inventory balance plus the cost of goods sold. Okay, I'm going to walk you again kind of through first in, first out, last in, first out, weighted average, and we'll talk briefly about specific identification. Specifically, we're going to talk about the effects in the inventory system. As I had mentioned before, the perpetual inventory system means that we continuously update the inventory as it's going through. The physical flow does not always follow the cost flow when it comes to inventory in the inventory system. What you need to be concerned with is your ending inventory on your balance sheet and the cost of goods sold on your income statement. So going back to that slide where we compared first in, first out, last in, first out weighted average, I want you to be very clear on how we found cost of goods sold and the remaining inventory balance. Those are the biggest takeaways. And that is what this slide is talking about. Here's some information. We have, it's kind of similar to the slide that we showed you earlier. We have beginning inventory plus purchases and sales that we've made plus more purchases and sales for the month of August. This company particularly sells mountain bikes. So here's some information. We started the month of August with 10 bicycles in our store. We purchased those 10 bicycles at $91 each. That gives me a total carrying cost of $910. On August 3rd, I purchased some more bicycles from my vendor. Just 15 of them at $106 each, giving me an additional cost of $1,590. That brought my inventory up from 10 units to 25 units on hand. On August 14th, I had some customers come in. They bought 20 bicycles from me at $130 each. It's not bad. That left me with 5 units left in my store. I had 25 on August 3rd. August 14th rolls around. I made 20 sales. So that leaves me with 5 left. So I call up my vendor and I say, hey, vendor, I need to purchase 20 more bicycles from you. Vendor says, no problem. That's $115 each today. Gives me a cost of $2,300. That brings my inventory up to 25. I call my vendor again toward the end of the month because I thought I'm going to have a big sale at the end of the month. Call again. I say, hey, I need to buy another 10 bicycles from you. The vendor says, no problem. The cost today is $119 per bike. That's a cost of $1,190. Gives me a total inventory on hand of 35 units on August 28th. Then, at the end of August, I had a lot of customers come into the store. I sold 23 bicycles that day at a sale price of $150 each. It left me with 12 units remaining on the shelf in the store. You can see if I total up all of the units that I purchased throughout the month of August, I bought 55 individual bicycles for a total of $5,990. I sold 43 of those bicycles. Left me with 12 bicycles left at the end of the month. Make sense so far? Okay. Great. Thank you. Now I'm going to show you the effect of all 4 cost methods. First, specific identification. Specific identification simply tells us exactly the individual bike purchase price and sale price. That's why we call it individual specification. But to find your cost of goods sold under this method, it's very straightforward. We take all of our purchases on August 14th, August 30th, we add them all up. Right? Multiply number of bikes times the purchase price, plus number of bikes times the purchase price, etc. We add them all up to get a total cost of goods sold of $4,582. So we take our beginning balance minus our cost of goods sold to get our ending inventory of $1,408. Now, let's take a look at first in, first out. First in, first out, we always take into consideration that we're going to sell that set of first purchases first. So using the first in, first out method, that means I'm going to first sell my beginning balance 10 bikes at $91 each. And I'm going to sell the purchases directly after that. Okay, 15 at 106. Then anything directly after that. August 14th, first sold my beginning balance plus an additional 10 bikes from my purchase that I made on August 3rd. Because remember, on that day I sold 20 bicycles. So I take my beginning balance, I started the month with $91 per bike at 10 bikes. I sold all of them, 910. And I also sold 10 additional bicycles. Those 10 additional bicycles came from purchases I made on August 3rd. I sold 10 at 106. That's 1,060. I take 1,060 plus the 910 to get 1,970. Am I left with 5 bikes remaining? $106 based off of the amount of purchases, right? Gives me a carrying cost of $530. And then I made some more purchases, as you recall, on August 17th and August 28th. And I made some more sales. Under the first in, first out method, I got to sell whatever the oldest stuff is first. So I sell first 5 bikes at 106 because that's what I had remaining, remember, on August 14th. Then I sold an additional 18 bicycles for the price of $115. That comes from my purchases I made on August 17th. First in, first out. But we noticed that it's on a rolling basis, right? It's on a rolling basis. That's why the first in, first out method, we take our purchases that we made first, we sell those first. And then purchases we made next, sell those next. You see? It goes in order. First in, first out. So that's the concept behind it. All right. Now let's look at this same example from the last in, first out method. The last in, first out. Beginning balance and August 3rd purchases, that's all the same. On August 14th, cost of goods sold looked like this. Remember, last in, first out. We sell the last amount of purchases first. I first sold came in on August 3rd. That was the last amount of purchases. So 15 bikes at $106 a piece. $15.90 cost of goods sold for that. I also sold 5 bicycles from my beginning balance. $21, $455. Give me a total cost of goods sold on August 14th of $2,045. Beginning balance was 5 bikes at $91, because remember, last in, first out. Made some more purchases, August 17th and August 28th. August 30th rolls around. Remember, on that day, I had a great day. Sold, I think it was like 20 bikes, right? Something like that. So, 23 bikes, sorry. So August 30th, I sold my purchases at 119 and then 115. Remember, last in, first out. Total cost of goods sold $2,685. Ending inventory balance of August, or last in, first out, was $1,260. And weighted average, very simple. Cost of goods is available for sale divided by the number of units on hand, the date of that sale. That's how this works. We take number of units on hand, cost of goods available for sale divided by number of units on hand. It's going to be the weighted average cost per unit. In this example, $100. The weighted average was $100 for the sales that I made on August 14th. And then the weighted average shifts, of course, as the month goes on. So for August 17, We took the cost of goods available for sale, 2,800, divided by 25 bicycles available for sale at that time, gave me a weighted cost per unit of $112 going forward. So with a weighted average of $112 going forward, I get down to August 28th. I made some more purchases. Cost of goods available for sale, $3,990 divided by $35. I'm sorry, 35 bicycles available for sale at that time, giving me a new weighted average cost per unit of $114. The way to think about weighted average is, since we keep making purchases throughout the month, we need to keep updating our weighted average. Yeah. And of course, at the end of the month, when I sold my 23 bicycles on August 30th, the average at that time was $114 per bike, giving me a cost of goods sold of $2,622. For the whole month, my cost of goods sold was $4,622, and my inventory balance was $1,368. You see, the weighted average updates as the month goes on. Because we're purchasing as the month is continuing, and we're selling as the month is continuing. So that's why you see the change in the cost. Now, the real reason why a company might select one method over another to value the cost of their inventory is for taxes. There's always a tax advantage. The tax advantage depends on the carrying cost. The carrying cost, if the cost is higher or lower, depending on the type of inventory and the type of the company that it is, it'll have an effect on the taxes, right? So that's why a company might select one over the other. But with first in, first out method, using the grocery store example, ending inventory approximates the current cost. Yeah. Last in, first out, the example we gave was Best Buy or Amazon. Cost of goods sold on an income statement approximate its current cost. Weighted average changes as it's being updated. Smooths on the price changes. It makes the variation a little smoother. Yeah. So those are the advantages. If we look at our earlier example with the bicycles, and we compare all four methods side by side, we see very interesting results, don't we? Our cost of goods sold very different from each one to another. Weighted average, first in, first out, last in, first out, and specific identification, different. They're all different. Then we also see the effect on our net income, also different. Now, which of these four is the best, you might ask? It depends on the business. It depends on the business treatment of inventory. One might say, whichever one gives me the highest net income is the best one to use. Maybe. It depends. It depends on the type of business. Or someone might say, the lowest net income is the best one for me. The reason why somebody might say that is because their tax implications will be a little lower. And we can see that through the income tax expense line. It's just interesting to understand the differences between the four methods and why we use it. Also very important to note, the IRS requires that when we use last in first out method, it's used for tax reporting and must also be used for the financial reporting. They call this the last in first out conformity rule. To help them to standardize tax code. That's what that tells us. And then one of the last concepts I want to tell you about, it's not as widely used, but it's important to understand. It's called the lower of cost or market. This is where the inventory must be reported at its market value when the market is lower than its cost. We call this a replacement cost. It's probably its most commonly used name is replacement cost. We apply this separately to each individual item or major categories or to the entire inventory. And this only happens when the market price is lower than its cost. The times you might see something like this can sometimes be seen in automobile sales. So the automobile industry would see something like this once in a while. This is the example of the journal entry would make. With inventory, it's also important to know that sometimes we make errors. And when those errors are made, we need to make adjusting entries for them. That's what this slide shows us. What the effect of inventory is, if I understated or overstated my inventory, what's the effect on the balance sheet? Typically, it follows whatever, because inventory is a balance sheet item, of course, that's going to have an impact on assets and equity. One of the last things I want to tell you about today, of course, are a couple of ratios. You know I can't let you go without a few of those. One's called the asset inventory turnover ratio. This tells us how well the company is selling through its inventory. We take the cost of goods sold and divide by average inventory. In accounting, when you hear the word average, we take the beginning balance plus the ending balance and divide by 2. Get the average. And another one of my favorite ratios is called the days sales and inventory. This tells me how many days it takes in order to sell through the inventory. We take ending inventory divided by cost of goods sold and multiply by 365 days. Very straightforward. And this kind of shows us a comparison between Costco and Walmart for their inventory turnover and day sales and inventory. Interesting. It's always interesting to see this kind of information and be able to compare one company to another, right? And that, my friends, brings us to the end of our discussion on inventory and how to value or cost that inventory using the 4 important methods of specific identification, first in, first out, last in, first out, and weighted average. Are there any comments, questions, or concerns about those concepts that we talked about? Anything at all.
So can I speak with you after the class?
Sure, of course you can.
Thank you.
My pleasure, Sanea. Okay. If there are no other comments, questions, or concerns, I would like to remind you of what's happening in the classroom. We are in week 6 under module 2. There's a homework assignment. It's due on Sunday night. I strongly recommend that you try this homework assignment on Thursday during the normal class time. If you ever need any assistance, anything at all, you can email, call me, set up office hours, or whatever you need. I'm here for you 100% of the time. And I also want to thank you so much for your hard work in this course so far. I really appreciate it. And I'm here for you, whatever it takes. Thank you so much. Enjoy the rest of your night. Have a wonderful time. Thank you so much. Bye-bye.
You too, Professor.